I'm starting off with a small story from my home country. The governor of the central bank is both, setting interest rates, but she's also the chairperson of the pension fund, our global pension fund, quite large. And she was asked, "How do you, as a governor of Norway's bank, cope with high inflation?" And she answered to the journalist, "Well, as a central banker, that's very easy. You just hike rates. But as the chairperson of a global pension fund, that's a very difficult task." So that's kind of linking monetary policy together with asset prices, which I'm trying to reflect upon. Now, Matthias had a quite downbeat presentation, and I fully share that. It looks quite dark because the central banks are kind of forced to address high inflation. And although a lot of these inflation impulses are coming from supply shocks, that you could argue that you shouldn't really react that harshly towards. There's essentially three channels central banks are at least addressing inflation. First of all, it's through the currency channel. So when inflation is high on a global scale, you try to limit the impact from high global prices on your home country. Well, a stronger currency certainly helps that way. The problem is that the currency market is a big zero-sum game. So when everyone is hiking rates, it's all about not hiking the least. Second of all, perhaps a big impact and effect from pandemic policies, essentially low rates and very accommodative fiscal policies, is that we see across the globe in almost all countries that high aggregate demand and very tight labor markets. Matthias mentioned the US. You could also look to the UK. You can look to the Nordics, but you can also look at the Eurozone. It's the tightest labor market in more than a couple of decades. Although you don't see necessarily that wages are responding yet in the euro area, certainly the central banks want to combat that. Or else you might end up with workers having a much better bargaining power now, demanding increased wages, essentially worsening the inflation problem further out. And that demand is often based on expectations of inflation going forward. So that's the third channel. Not that easy to kind of grasp, perhaps, inflation expectations. But it's extremely important in all central banks' model frameworks. And if we stop believing in the credibility of central banks that they can return inflation back down to 2%, it's going to make things even harder to restore low and stable inflation around 2%. So that's kind of the three channels central banks now try to address. Rapid pace and high policy rates. And it's across the globe. This map here shows in the dark orange color all the countries in the world that at the previous policy meeting actually hiked rates. The yellow one is the few outliers, China, Russia, and Turkey, that actually lowered policy rates. China has a pandemic issue, Russia has a war issue, and Turkey has a policy issue, I would say. The white ones have left policy rates unchanged, most notably Japan, where inflation still remains quite low, for now, at least. Perhaps because expectation about inflation remains very low in Japan. Looking forward, talking about interest rates, going on to asset prices, I like to divide the response function of central banks into two parts. It's the real economy on the one side, and it's the inflation part on the other side. That's really what matters for them. Here is the OECD leading indicator. It's the OECD's measure of the kind of the growth momentum among the OECD countries 6 to 9 months ahead. It's below zero, just updated a couple of days ago. So it says that growth is slowing. It's probably going to mean that all these big OECD countries are going into a more contractionary period. But I set up two black lines here. I call them the credibility band of central banks. Because as long as you manage to maintain the growth momentum within that band, you're sort of home free. In the sense, developments are sound enough to continue as normal. Whenever they drop far below, as you have seen during the pandemic, during the financial crisis on a global scale, you could add also the euro downturn for Europe, for instance, you get all these aggressive policy measures, QE, cutting rates massively. But the thing is, also with this credibility band, is that whenever the growth drops below, you see asset prices also dropping, selling off, credit spreads widening. So on the upside, that's pure joy, right? Good growth, prosperous times ahead. Well, this has been the case for the past 20 years. Now we should also add inflation to that picture. We've had low and stable inflation, so kind of the upside risk on that credibility band has been kind of disregarded both by markets and policymakers. But now all of a sudden we're in a situation where inflation is way too high. Way too high. And central banks need to restore credibility. And as long as the growth aspect of the economy is not that bad, it's actually a quite handy tool in order to address aggregate demand and try to slow down development in labor markets. Now we can add those two components together and get kind of a measure, an indicator of what central banks actually care about. That's the current inflation and a measure of what you could deem as future inflation. So the slower growth today, the higher the probability that wage demand, etc., in 1 year, 2 years' time will be lower. So we add those two together, and then we look at the reaction functions of central banks. So it's a G10, that's all big Western central banks, including the ECB, Bank of England, Federal Reserve, etc., and just looking at the change in policy rates over the past 6 months. So you get kind of the momentum. Are they in a hiking cycle or in a cutting cycle? Whenever this output and core inflation drops below the credibility band, they do QE, they do policy rate cuts. But whenever we're above the credibility band, they have to hike rates fast. And that's what we're currently seeing. And the problem is with high inflation is you get high interest rates and you get a positive correlation between asset prices, equity prices, and bonds. So there's really nowhere to hide. Central banks are in the business of credibility. We need to have credibility around the inflation target. So that's our main belief here, is that the real developments, the real economy will not hit a crisis. So it's not going to drop down below that credibility band. Then all bets are off, I'm guessing, for central banks. But they have to maintain high policy rates until inflation is down, let's say below 3% at least. And that's going to be a tough job. That's going to be a tough job. And the thing is, the reason for it to be a quite tough job is if you look at US core inflation, just for an example, I could have brought up German inflation as well. If you look at what happens during recessions, is essentially that inflation is one of the last indicators, economic indicators, to start declining. It's a very lagging indicator. And when currently inflation is the biggest problem, and central banks are now in the business of restoring their credibility, they can't anymore just hope inflation will come down. They need to see it. So that's probably one of the best reasons why next year is going to be a quite lost year. Well, markets have seen this coming. If you look at market pricing and market cap, this is the world MSCI, that's a very broad equity index. And then you look at index for global bonds. The combined market cap has declined by more than 20 trillion US dollars since the beginning of this year. Now, that drop in market cap is bigger than the financial crisis and the dot-com crisis altogether. So there's already a lot of negativity priced in. One of the big reasons you've had this big drop is because of the correlation sign. Whenever inflation is high, interest rates increase, both bonds and equities sell off. That was not the case during financial crisis or during the dot-com period, because central banks started cutting rates. So bond values went up. Now they're both dropping. The big question for investors, private persons, is of course, is this already enough? Have we seen the trough? Should we start buying equities again? I think it's too early, to be honest. And it's always hard to make forecasts about asset prices. Eventually, all forecasts are wrong at some point. But if you use more than 100 years of history, looking at pricing of US S&P 500, the cyclical adjusted price over earnings indicator, this is the red one, currently pricing in roughly 30 years of earnings. That's the price you pay for a broad S&P stock today. And then you look at, after 10 years, what's your annualized real return. Now, that correlation is not perfect, but it might, if at least history rhymes, you're now able to lock in 10 years of negative real return. That doesn't imply that the S&P or equity prices in broad might increase 10% over the next time. It just underlines that market pricing is still relatively rich, and our belief that central banks have much more job to do. We don't get that Fed put as long as inflation is high. We don't get the ECB put as long as inflation is increasing and remaining very high. And all of a sudden, you now have there's an alternative. That was not the case in this low interest rate environment with negative real interest rates for a long period of time. Today, you can lock in 10-year real yield treasury bonds at 1% positive. So certainly, you have an alternative. And that's also going to weigh on longer-term investors that might need to see earnings coming down, earning forecasts coming down, going into next year. And I think that's going to happen. So that's going to make prices also come down a bit, perhaps, and make it more attractive as long as we see things normalizing also in the economic sector going forward. But it's not only equities, it's also house prices, an important accelerator for private wealth, consumption, and a positive multiplier in the economies. We've seen a rapid surge during the pandemic, low rates, but people kept their jobs mostly, at least after a short while, and they got fiscal stimulus packages sent to them. And we saw house prices increasing across the globe. Some places more than 30%. in more than 2 years, in just over 2 years. With higher interest rates, leveraged households, of course, are feeling the pain, and we see house prices dropping. Now, there's an important element, which I think also will be important going forward, and that's looking at the fundamentals here. Although housing prices are, by this chart, looking quite average in Canada, for instance. Well, if you look over the past 20 years and adjust them for the real, for personal disposable income, so how much is the increase in house prices accounted for by the increase in disposable income? You see a couple of countries standing out, whereas, for instance, Europe, Nordics, and the US is much more in line with fundamentals. And that leads me over to actually the last topic here, which I think is increasingly important for the coming decade. We know nothing about what's happening next year, but let's talk about the next decade then instead. The 2010s was all about tight fiscal policy, austerity measures, and loose monetary policy. Now, after the pandemic, we've probably learned that fiscal policy indeed works. And central banks have learned that inflation also have an upside risk. Could that entail that we're kind of flipping the narrative from tight fiscal policy and loose monetary policy to looser fiscal policy wherever it's possible and tighter monetary policy? If so, we're going to have a decade where cash flow is becoming increasingly important, and certainly also the amount of leverage. So reflect on that. I think that's going to be an interesting topic also to follow over the coming years of Swedbank Economic Forum. Thank you.
Thank you. Thank you, Kjetil. You forgot...
the Euribor.
But I have not. So, markets now expect... I think Americans... I'm always irked. Euribor. Americans say Euribor, and British say Euribor. So, that's just explanation why we say the same thing differently. Markets expect Euribor to be at almost 3% in the middle of next year. Do you agree with the markets?
For the time being, I could tend to agree with the markets, yes. But the biggest element there is actually for European politicians to get control over energy prices. I think that will be because of FX channel, because of wage growth in Europe going forward, and certainly also because of the expectation channel. So if you manage to kind of manage the energy issue here, you could also see inflation coming down quite rapidly and bringing more confidence to the ECB that they don't have to really hike that aggressively going forward.
I think you illustrated quite well the divergence between inflation and OECD leading indicators, which could basically mean economic activity.
Exactly.
Consumption, production, wages, employment, and so on. And I think the essential question here is at which point falling employment, falling consumption, falling manufacturing becomes more important for the central bank than larger inflation. Because for now, what you said, central banks are, what words did you use? Fixing their reputation, controlling the damage, or they're doing something that they should have been doing 1 year ago, and they're increasing interest rates when we already see that Germany is in recession. So, I mean, my personal view, and this is our official Swedbank forecast, is that the ECB will stop raising interest rates at the end of this year because of the dire situation across euro area. And when I get back to what Matthias said, 2% global GDP growth is not terrible, But I mean, if you exclude global financial crisis, and if you exclude the pandemic year, that's the slowest growth in 30 years. 30 years. And at the same time, we make the assumption that central banks will stop at some point during the next half year and will not increase interest rates at the pace that they have never done before. But if they don't stop, if they will continue increasing interest rates, then 2% will be an illusion, and we will see an even darker outcome. Would you agree with that?
Absolutely. I think the trade-off for central banks now is the first central bank to fold on hiking will also lose its currency, which implies higher inflation. So that trade-off is very hard. So I think for central banks to stop permanently on hiking rates and be more dovish in their, or careful in their language going forward, would be a high probability of a systemic risk. So a big fallout in aggregate demand or real economy. Until then, central banks, take Bank of England for instance, forecasting a recession for 6 quarters, continue hiking and increasing the pace of hikes. So that's how important the credibility side with restoring inflation or converging inflation back to 2% going forward. And I think also most central banks, we like to look at growth, not that often look at levels. Level of GDP is higher than before the pandemic in most Western countries. So when the central bank is looking at, if we take GDP back to 2019 levels, it's not that bad. Inflation is more important. And as such, fiscal policy can do the work, the heavy lifting on the GDP side.
We have one more, I mean, we have many more questions, but one more we need to address is, I mean, it's an interesting question. Have the problems of the 2008 not been solved during the last decade and pushed forward? And now they're materializing once the central banks are no longer there to put the pillow in front of the markets.
Talking about the issues in financial markets or
well,
in...
For example, real estate prices in the US are twice as high as they were at the beginning of 2008.
Yeah.
Is that a problem? Or?
You've seen it across the globe, and it's one of the things that Matthias also touched upon. People aren't used to living with that risk that interest rates indeed can increase fast and to a much higher level. They've been used to and accustomed to central banks always having this pot, you know, saving you whenever your values are declining. But that's only the case whenever inflation is low. So current inflation low, and also with the outlook of future inflation becoming lower. That's when you get saved by central banks, and not today.
Has euro reached the bottom versus US
Sorry?
dollar? Has euro reached the bottom versus US dollar?
Again, it's fully a question of the energy situation in Europe.
But that's a good answer. It means that fundamentally euro is cheap. Cheap because ECB is somewhat behind the other central banks.
Exactly.
And if in some miraculous way we would see a resolution to the energy crisis, euro would be much more expensive versus US dollar. Is there a way to solve this energy crisis? No, maybe I'll ask this question to Vytenis after the break. Another question for you is, if you had to, you said that equities still look expensive and the bottom, they may have not been reached there. But if you had to, where would you put your money? US equities or European equities?
In a very short time, there is a bigger downside risk to Europe, I think, because of the economic momentum. And we see that ECB is not there to support the real side of the economy, rather the contrary. But looking into my crystal ball and addressing this kind of fiscal monetary policy mix question going forward, I would rather stick to more lower leveraged markets, and that's where you find Europe. So tech stocks, highly leveraged. I think if you have 10 years, 5 years of high real interest rates, that's going to be a big issue for the US equity market going forward.
Yeah.
So pricing is much higher in the US than it's in Europe.
Exactly. A lot of bad things are already priced in Europe, and that's where I agree with you that, I mean, this is where we probably are different. During the last decade, I mean, whenever there were some problems, central banks would come in and what you call the Fed put. This is perhaps not very known jargon for many people, but it's basically providing an insurance. If the equity prices are falling, central banks lower the interest rates and start printing money, and the equity prices go up. If you look during the past 12 years after the global financial crisis, small blips, but the overall general trend upwards. So what is likely now is that not enough to throw money into equity markets with your eyes closed, but you need to be more careful in picking the gems,
and you see
which
how,
exist.
you also see how sensitive equity markets or credit markets, bond markets are to inflation prints today. That's mostly on the high, like the total index, including energy and food prices as well. If you look to US, the key aspect here is that wage growth is still, I could say, above 5%, depending on which measure you use. Yeah. And it's hard to get 2% inflation over time with extremely tight labor markets and high wage growth. So that's the job for Fed also going forward.